Hello folks, very good evening for joining this presentation. The topic given to me by Martika's team is breaking away from traditional to contemporary investment vehicles, more behavioral than anything else. So my name is Shravan Kumar Srinivasula. I work with Birla Sun Life Mutual Fund as a fund manager. So I thought it will be a good opportunity to combine what we do at our fund house, the relevance which has in the current world, and then try to map it with the understanding of our clients and those who are trying to migrate towards mutual fund space. So that's where this breaking away from the traditional methods of investments is coming from. And at the end, I would like to touch upon other vehicles of investment, taking loans, or anything to that aspect. So let me start with the first topic. See, currently we're living in a multi-paced world wherein our consumption needs are instantaneously met. We have instant food. So if you're hungry, you just take 2 minutes for you to make Maggi and the food is ready on the table. Or you call up any of these Ola Chef or any of the nearby vendors. They would come and deliver it to your house instantly. You've got instant service where you want to go from place A to place B, and all you have to do is book a Uber or Ola cab or whatever it might be, and then you're all set for your service. Instant sharing where you have WhatsApp if you want to communicate anything with your friends, or Instagram if you want to post something, or Facebook and the likes of it, the infinite number of them at this point in time. And practically Twitter has replaced watching media channels for most people. So instant sharing and instant communication is something which has changed the world where we are. And everything is leading to instant gratification. I want a movie, I get a movie. I want to eat something, I get something to eat. I want a service, I want a massage, I go to a place and get it done. So the consumption needs are fast-paced, but one has to be cognizant of the fact that consumption is one part of a life, but whereas investment is another part of the life. Investment is nothing but postponing one's consumption. If somebody is given 100 rupees today and he can choose to spend the whole of the 100 rupees, but what should ideally happen is that he or she chooses to save a part of these 100 rupees so that the consumption needs at a later point in time when the income is not there gets met. So for example, if you become 60-year-old or 65-year-old, one may or may not be employable at this point in time. For one to consume things at that point in time, one would have to set aside that portion, and that's called investment. So we have two-paced things happening in our life. One is consumption, where there's an instant gratification, instant sharing, instant service, which is happening. But whereas in the investments, we are a little confused. Most of us are a little confused. But I think most of us are trying to catch on because of a lot of awareness which is going around. Just to elaborate the point, if you ask many students or parents, even to this date, people would say that I would either want to be an engineer or a finance, or I would want to get into medicine or IT. So the huge dilemma of choices this still has, whereas the world has moved wherein even people, the sports people get paid a lot of money, even musicians have a lot of avenues to make money, even people who are, let's say, artifact collectors, museums pay them a lot of money. So there are a lot of other fields which are opening up, but somehow most of people are still drawn or fascinated towards these fields with or without their interest. That's something which is very intriguing. So we are in this mind share because of the influences around us. Influence can come from multiple sources, which might be the parents or relatives or old friends or whoever it might be, which would keep one rooted to those old ideologies or beliefs. If you move forward and see, there's a funny clipping which I got to know. There's an advertisement looking for a bride. The advertisement goes, looking for a fair, beautiful, slim, highly educated girl from a cultured value with good moral values. She should be homely and be able to follow all traditions of my family. She should be able to mingle with people across all ages and backgrounds. She should be fun-loving and outgoing. She should know how to cook my native cuisine. So if you look at the dichotomy, on one side you would want somebody who is highly educated, and on the other side, you would want her to be able to be doing all sorts of things, which is being homely and being to mingle with people, following all traditions. She should be fun-loving and outgoing, but at the same time following all traditions, etc. So there's a dichotomy. It's not only with respect to, let's say, this looking for a bride. Even some of the advertisements looking for grooms is just the same. So I'm not pointing out at one side of the male-female argument, but it's generally a confusing thing which goes on around people with a lot of influences from the people around us. So the dilemma of investment choices is also there. So as I've spoken about choice of career or choice of a person, there's a dilemma investment options also. Because we have seen our family members subscribing to, let's say, the policies from LIC, or putting fixed deposits in State Bank of India, or buying a mutual fund from UTI, we are restricted, most of us are restricted, at least the first investment is restricted to these kind of investment vehicles. But on the other side, there are new upcoming investment vehicles which have evolved over the last 20 years or 15 years, and new avenues are coming going forward. And the focus of our discussion today is going to be mutual fund, because we believe, and I personally believe, that a mutual fund is a very, very, very efficient vehicle for meeting one's investment needs. Again, in investment, the key criteria and the essence is having patience. Again, contrasting between the consumption world and the investment world, it takes 3 seconds to share information, 3 minutes for an online payment, 3 months to learn a new thing. But for the investments to yield results, it takes at least 3 years. One of the jokes which I joke around is that how many months does it take for an 18 years to be after birth? It takes 18 years for a person to fully evolve as an adult. So even for investments, it's the same case. So it starts yielding results maybe after 3 years or 5 years, 7 years, but one has to be keeping an effort to keep the investments growing. And patience, who else epitomizes that than Sachin Tendulkar? So if you look at Sachin Tendulkar, the golden standard of cricketing fraternity, got his 200 ODIs after playing first-class cricket for more than 21 years. And so he scored 34,000 odd runs slowly. He had hundreds in his career spanning almost 25, 26 years. It's only in the 21st year that he was able to score 200s. So it's all about patience to achieve something. So even in the 200 which he has scored in Gwalior, he had faced 50 balls which were dot balls, which goes on to say, and more than 1/3 of the balls are actually dot balls, which goes on to say that at any field, and particularly for investments, patience is the key, and one has to be put at it every single day, every single week, every single month to achieve one's result of maybe wealth creation or anything which we might have. Now, for everybody, the ideal aim is that the customer expectation, which is your expectations, should convert into your returns, the customer returns should convert into what you're investing in the scheme returns. So most of the time what happens is that if you see the scheme has given a 15% return in the last 10 years, a lot of people ask, but I have not made money, right? If we say that markets have gone up, let's say 10 times in the last 20 years, people say, I have not made money. The reason being, there is a dichotomy between what one experiences and what one has seen in all these advertisements or all these marketing materials, etc. So our humble request to everybody is that, again, with the philosophy of patience, one has to keep accumulating in the right product every single month or every single year, so that your expectations may not be equal to the returns which you're expecting, but almost equal to the returns which you might be expecting. And by choosing the right product, it will be the right schemes. For example, if you want to buy a motorcycle which is worth about 50,000 rupees, and if you want to save 5,000 rupees every month, it takes about 10 months for you to get there to achieve the goal, which means you choose, let's say, a fund which is very, very safe, keep investing 5,000 rupees. At the end of the 10th month, you get 50,000 odd kind of rupees. So which means that you're expecting that you would want to buy a moped, which is 50,000 rupees. Your returns are about 50,000 odd rupees, and that is delivered by the scheme which has given you that 50,000 rupees in that 10 months time frame. Similarly, if you plan for a longer term horizon, so if you're planning for, let's say, 20 years kind of horizon, so if you start investing at let's say 10,000 rupees per month kind of a thing, and if you want to allocate a corpus of about 60 lakh rupees, and your expectation is about 8%, you can get there in 20 years. But if that 8% becomes, let's say, 10%, then your money will go to about 75 lakh rupees. So which means that your expectations were muted at 8%, markets have delivered a little bit more, so you make 10%, and hence you were able to achieve the final corpus, which was much more than what you set out to achieve. So that's where I was coming from. One, expectations have to match the returns which the customer has to gain from, and that is only possible when you choose the kind of products to achieve those kind of goals. Now, why do I say that mutual funds are the best vehicles for investment? The mutual fund industry has been in existence since the UTI days, but it's only in the last 20 years that there are various private players which have come into existence, and because of competition coming in, there are a lot of variety of products which are available, and most of the people are benefiting. And still, we are a very, very small part of the entire investment profile across the country. For instance, on a yearly basis, there are about 90 lakh rupees which goes into fixed deposits, but hardly about 2-3 lakh rupees come into mutual funds, whereas mutual funds are much better products if you compare apples to apples. So debt products are compared to fixed income, fixed deposits, and even the corpus which we are getting into fixed income is about 1/30th of the money which goes into fixed deposits. So if you look at mutual funds, they are regulated by one of the most stricter regulators in the world, which is called SEBI. There is an ease of transaction to do. There are a lot of advisors who are available. There are a lot of online systems which are available. There is transparency. Every month the portfolio gets disclosed. Every day the NAV gets disclosed. You want money at any particular point in time, you get money in 1 or 2 days. You can invest at any point in time on a daily basis. It's hyper competitive. There are about 43 mutual funds existing in the country today. Each one of us are trying to outwit each other almost on a daily basis. It's hyper competitive. Superly educated folks who are running this mutual funds and investments. It's a marquee kind of a job which everybody from B school would want to join. Everybody want to be associated with mutual fund, and it's at the end of the day tax efficient. because if you look at it is the tax structure for a debt fund less than 3 years, it comes under your marginal taxation. So if you're paying a tax of 10% for your other income, you pay 10% for this income as well. If you pay 30% for the general income which you have, you pay 30% for that income as well. But greater than 3 years, there is indexation benefit, which means the government is saying that you can remove the inflation part of it and you pay tax, which is 20% on the rest of the money. So there's a huge tax benefit which is available with the mutual fund. On the equity side, less than 1 year is short-term taxation, and greater than 1 year is zero capital gains tax. So there's a huge benefit which the mutual fund provides, and that's the reason why I say that mutual funds are very, very, very investor-friendly in terms of one's investment profile. The types of mutual funds I just want to touch base upon. So I understand that people are from various ages, various backgrounds. So I don't want to leave out anybody. Want to keep it as elementary as possible to cover as much ground. If there are any other complicated questions, I would like to take them in the Q&A. But for the benefit of everybody, the different kinds of mutual funds which are there on the left-hand side are debt mutual funds. So depending on what horizon you would want to invest, if you want to invest for, let's say, 3 months to 4 months, the example which I gave about buying a moped for 50,000 rupees, you would want that money to be as safe as possible for the next 10 months for you to redeem that amount or rather take over the amount and buy your moped. So in that case, you would go and put your money in liquid funds or liquid plus fund. In case you have longer horizons, you would put money in, let's say, income funds or accrual funds or dynamic bond funds. I would not go into definition of each of these things. That's something which maybe you would have to study on your own at a later point in time, or in the Q&A if you were to ask questions, depending on the time I could stress upon that. If you look at on the right-hand side, you would have equity funds, which are again classified as large cap, multi-cap, mid-cap, small-cap, sectoral funds, the various classes of funds which are available depending on the suitability of for the client. And we also have hybrid funds, which are a mix of equity and debt. There are funds which are available which has gold component in it. There are fixed maturity plans. If somebody were to invest for 2 years or 3 years or 1 year, there are frequently fixed maturity schemes which come, which are primarily a replica of fixed deposits. There are fund of funds which invest in other funds domestically as well as internationally. Somebody who would want to start very early, I think fund of funds is a great structure to go by the time you learn things, and then once you learn things, you can go directly invest in the other funds which I've just spoken about. There are international funds if you want to tap into Japan, if you want to tap into, let's say, global commodities you would want to play, or you would want to go and invest in global real estate. So there are international funds which are available across mutual fund houses. And the last category is dynamic asset allocation. So if you're saying that I don't want to bother myself with a lot of ups and downs in the market, I would want to manage it to take care of it. So dynamic asset allocation, depending on the valuations of the market, would invest in a risky asset at one point in time. If the riskiness of investment goes down, then he would take more allocation to that riskier asset, which is equity, at an appropriate point in time. So there's different buckets which are there among the mutual funds. This is primarily anybody who would want to invest, right from a new small born baby to a person who is retired or on a deathbed, somebody where to invest. So these are the class of funds which are available across the mutual funds. I just want to highlight some things on mutual funds. So some people believe that investing in stock might be good. It might be good, but what happens from a psyche perspective is the propensity to invest reduces when you do something on your own. To give a parallel example, doctors do not operate on their relatives or their own kith and kin. The reason being, it's mentally torturous to operate on one's being, and one may not be objective in doing it. Similarly, in stocks, if you have found something on your own, if you got a tip, etc., and that's when you're starting out, the amount of money which you would commit is only a small amount because you've always cared about it. But if you outsource your investment to a third party, the propensity is that that guy will take care of my money, and hence it is seen that if somebody were to invest 10,000 rupees in stocks for a particular stock, the 10 times that amount can be given to a mutual fund. So he would rather give 1 lakh rupees to a mutual fund and see his investment running rather than he himself doing on stocks. So that's a behavioral trait which a lot of people miss upon, and also the added advantage of the research and all which is there with mutual funds. So even investing in stocks, if some way to do it directly, one has to actually see the amount of time you spend. Is the risk reward favorable? And secondly, if somebody were to believe on somebody else, what they're saying in the market, etc., so in the information pyramid, in which segment do you lie? Do you lie on the top segment where you get information very quickly, or are you in the bottom segment where everybody else in the market have actually acted upon that particular information and you're getting it at this point in time? The second aspect which I want to focus upon is that so some people blindly say that equity is risky, debt is not risky, etc., etc. But that has to be correlated with the horizon of investments which you're doing. For example, if you take the analysis of equity which is given here for a 3-year time frame, let me just change the color here. For a 3-year time frame, the probability of downside risk is 12%. But whereas the risk comes down to 3% for 7 years, and if somebody were to invest for 10 years, the risk has come down to actually 0%. Right? Similarly, if you take SIP, which means systematic investment plan, if you are doing investment on a monthly basis, on a 3-year basis, you would have had returns of about 30 to 33% across various funds. But whereas on 15 years basis, the returns are anywhere between 19% to 26%. So here I'm not saying that the returns which you have seen in the past are going to be seen in the future as well. That's a strict disclaimer, because SEBI doesn't allow us to say how much return you make in the future. But then the past provides a platform for you to see that one, the returns could be much more than what you can essentially make, compared to your alternative asset, which might be fixed income or chit funds or anything like that, and being the best of the lot, serving the needs of the investment people, can they actually deliver it going forward. And also, second point is that if you look at the index has given 14%, but whereas the funds have given 19 to 26%. Again, this is entire discussion about ETFs performing well compared to the funds, which is true for developed market like US, but for still a country like India, it is still yet to be proven, because there's a lot of alpha creating opportunities which are available in India. So that's, I thought, another point which I would like to make. So if you are an individual who would put money for 20 years, 10,000 rupees per month, at 8% you make 60 lakh rupees. But the same amount of money, if you are put and that would have generated 20%, then you would make about 3.1 crores. So as an individual, one has to think. So if you have 60 lakh rupees, what would you buy? And if you have 3 crore rupees, what could you buy? So there's a huge lifestyle difference between somebody who takes risk and that's calculated in a way, and somebody who doesn't take risk and acting safe at every point in time. So my humble submission is that the risk has to be seen with the time frame which one has to invest in, rather than looking at the pure character of risk of a particular instrument. Now, again, we are firm believers of asset allocation. We don't blindly say that you go and buy every asset which is available with you. There has to be a proper diversification of asset depending on the age and profile of an individual. A lot of people ask, how do you define risk? Risk is not the fancy formulas which you see in the B-school textbooks of standard deviation, etc., etc. What I would say is, how much money can you lose? So if you can lose 100 rupees, and if you think that the market can correct any time 20%, then you would have to invest 500 rupees. So if you invest 500 rupees, if markets were to correct 20%, you lose 100 rupees, you're still okay. So that's the way I would look at investing. So the way to see that particular amount of money is not lost is by combining multiple asset class, which is debt and equity together, and asset allocation is the way going forward. And also a lot of dynamics which are happening. For example, a European company in the US was caught for cheating certain emission tests, and the US authorities have actually fined, and the European company actually fell in the European markets, and the next day the Indian company which supplies to the European company also fell. So something going on in US. The company which is in India actually had to take the heat. So the stock, which is Motherson Sumi in this case, has lost about 40% in a couple of months time frame. So it's always better to diversify one's portfolio and diversify to an extent where multiple asset classes are represented, so that you don't get caught on the wrong side. Similarly, in asset allocation, there has been a multi-year rally in the United States, but the genesis of the problem is one way to sit back and think about it. The epicenter of the problem of the global financial crisis starting in 2008 has been US. But the paradox is that the country which had the genesis of the problem is the one which is actually given the best returns over the last 6-7 years time frame. Crude is one more example where I would want to highlight the kind of destruction of price which has happened. So people were talking about crude coming down below $100 or $80 for years together post the financial crisis, but it almost took only 2014, 6 years after the financial crisis, for crude to come down, and less than 2 years or 18 months into this, the crude has fallen from $120 per barrel to less than $30 per barrel as recently as February. So nobody thought that 75% of price erosion would happen. And think about those people who have been in energy stocks or lent to energy companies. They're completely wiped out. The only way to protect oneself from doing that is by diversification and asset allocation across various classes. You would have heard of various firms, high-yield firms like Third Avenue, which got bust because of over-leveraging to the oil companies. Yeah, it's the same thing. We're just saying that there are multi-order derivatives at work. Something happens in US, gets affected in India, and it's happening on a regular basis because of the kind of interconnectedness across the globe which we are seeing at this point in time. So there's a lot of music which is happening in terms of quantitative easing, etc., etc. The music is on. The music can stop anywhere. Still, people are figuring out that's $1 billion question. So you would straight away make $1 billion if you know the answer to that. Nobody has an answer to that. But the way to play it is rebalance the portfolio quite often. Try to participate across asset classes and try to benefit from it to capture the goals which are set out to achieve over a period of time. Again, in the mutual fund, we believe that the influences of the portfolio are many, but primarily there are two parties who can actually safeguard your portfolio. Every day there is something or other which is happening in terms of economic changes. So RBI can come up and decrease repo rate, increase repo rate. SEBI can come up as a regulator, can put in a lot of restrictions. They can say that you may not lend more than 10% to a particular company or a group of company, or things like that. There are companies which are coming up with results, announcements, decisions. So some company want to buy out a company abroad. Somebody want to invest in their capital expenditure at this point in time. Other decisions, right decisions, wrong decisions, etc. These are impacting the prices of the companies. Again, there's a government which is there, which let's say signs Mauritius treaty or gives a budget or passes a bill, etc., etc. So there are a lot of dynamics which are happening across the world and in the portfolio also. And as an investor, to take one call as to the portfolio, the mutual fund is holding, let's say one stock, which is Infosys or TCS, and taking a call on it is very difficult. The call can be taken by only two individuals, which is the fund manager who is managing the portfolio on a daily basis. He can, let's say, overweight Infosys, underweight TCS, and he can play out for the best interest of the investor. And secondly is the distributor, because he is the one who keeps track of the fund managers who are managing the assets and sees whether you have to be in a particular asset class, and if it is an asset class which you have to be in, you have to be in which manager. So from a tax efficient basis, it's the influence of your portfolio is majorly done by fund managers and distributors. But I have seen that a lot of people take calls on their side. Some people take cash calls. Some people take, let's say, stock calls. Just looking at one stock among the 50 stocks which the portfolio manager holds, decides whether he has to invest or redeem money in that fund. So the primary essence is that it's the fund manager and distributor who are major influences of the portfolio. You just have to be patient if you have chosen the right one to go with initially. Now, a lot of these questions which come is how do I create my wealth over a long period of time? The slide is a little tilted, but what I would do is I would divide the money into 3 buckets. I would divide the money into liquid, which is a safe asset. So even if things were to go wrong for the next 20 years, I would not have to see bad days. So that's the kind of bucket which I would make. So let's say if I'm making 3 buckets, right? This bucket would be the safe bucket. I would invest my money in. So I would invest my money in likes of liquid funds, debt funds, fixed deposits, which are ultimately safe. Then I would invest. The second bucket would be anything which can give me market-linked returns, right? If let's say market gives 20%, these funds should be able to give me 23, 24% or roundabouts. So that is a market bucket which I would play because if I have to beat inflation, if I have to buy the same amount of milk after 20 years, I would have to be able to purchase that. As I said initially when I covered, investment is nothing but postponing of consumption of today, and hence I would want to be invested in market-related opportunities. The third bucket is extremely risky, but if it does well, then your lifestyle goes up one notch. So these 2 are the buckets where your lifestyle is still maintained, let's say after a certain time frame. But this is the bucket where you invest in stocks or mid-caps companies or mid-cap stocks or sectoral stocks or funds. So anything which is risky, so if the stock goes up 10 times, your net worth goes up immense. So maybe instead of let's say traveling in a small car, which is let's say Alto, you can buy a Mercedes-Benz to travel across. So that's the kind of portfolio one would have to create. So first is liquid money, safe, ultra safe money. Even if world goes bonkers, there is no need to worry. The second is the bucket which beats inflation. So overall, these are the 2 buckets which have to take care of your daily needs. These are the 2 buckets which have to take care of your daily needs, and the third one is the one which puts the ball out of the park, as they say. Now, I would just want to give a case study as to. So at the end of the day, all this comes to the return. So in one of the slides, I've spoken about how some of the funds over 15 years time frame have given excellent results. So we did a study wherein a couple of our funds which have started 19, 20 years back, the kind of returns which they have done. So in 19 years, we have this Villa Tax Relief Fund which has gone up 104 times, and BSL 95, which is balanced fund, our balanced fund, has gone up 59 times in 20 years. So just to give a perspective, if somebody were to invest in Villa Tax Relief Fund instead of investing in a house, today after 20 years, he would have had 17 such houses, right? So there are only few kind of asset classes which can give such a kind of return, and we firmly believe that equities is one asset class which can actually give that, just to give a time frame. Now, just closing down, so one important thing which I would want to share is, as I said, a lot of people are new or are new to investment. One of the key criteria is to have an advisor or a mentor with you, so that you do not do some of the wrong steps which they might have done at that point in time. I just want to quote rather just want to reflect on what happened, before the war between the Kauravas and Pandavas, is that both Duryodhan and Arjun had actually gone and met up with Krishna, and Krishna offered that I offer myself for your service of my army, and Duryodhan took the army, but whereas Arjun took Krishna. So it's all the more important that even if you have an army of people, it may not add any value, but to have one right person is very significant. So I see a lot of people, at least the place where I live, which is Mumbai, that they have 20, 25 advisors advising them, but the real value add is with one or two people. So instead of wasting time with 20, 25 people, it's better to be concentrating on one individual or one entity to get all the investment advice. So criteria of selecting advisors, I just have put up, it may not be an exhaustive list, is that one should have a good educational background, one should be aware, the curiosity of learning has to be there. He or she should be able to correlate with what is happening around the world, with what investment decisions one has to take. One has to have necessary certifications with the regulator, as well as some of the basic finance courses. And two important things is he or she has to understand your goals, be empathetic to what you want to achieve in life, and then most importantly, which cannot be compromised, is the trustworthiness. Can you trust this particular person? Because markets go up and down. Markets are not a linear progression of things. So can he or she deliver bad news to you first, and in a way where you could have a lot of trust by giving your money even at that point in time to the person, because this is a long-term relationship. This is not a short-term relationship. So till now I've been discussing about mutual funds, the other contemporary vehicles which you can use. Apart from investing, there are something else. For example, home saver while taking home loan is a very interesting concept, wherein if you have certain amount of money, you put money in this particular home loan account. The interest for that particular piece of money is not charged. So instead of the money sitting in, let's say, a savings bank or fixed deposit, the money is there within this loan account. So to that extent, the interest is not charged, which means practically you're talking about interest-free, tax-free interest, which you're getting when you invest the money. For example, if the interest rate is 10%, if you invest the money, that much interest component goes down, and that extra component will go into your principal. That I think is an interesting proposition by some of the banks which have been given. So SBI gives it as max gain, Standard Chartered gives it as home saver, which I think is a very interesting concept. So one more thing which you need to understand is that value is, so at the end of the day, there is no free lunch. So somebody has to take the risk. So once somebody is proposing an idea, you would have to realize who is that person who is taking the risk. Is it me or is it him? So that becomes very important. So in, let's say, case of the home saver account, the bank is saying that I am offering you the same interest as you pay me on home loan. So the risk is not on you, the risk is on the company. But whereas if somebody were to come and tell you that, okay, I would offer you, let's say 100 rupees worth of asset, but you would have to pay me on day 0, and you be the collateral guarantee for my loan, which means the risk is not on him, but the risk is on you. So one has to understand, even if you're getting at a discounted price, at a lower price, who will bear the risk and for what period of time. So if you're bearing the risk of 1 or 2 days, or let's say a month, the visibility of the risk is there. But if one were to bear the risk for 5 years, 10 years, 15 years, the cycles are entirely different, and hence one would have to see what risk one is bearing for that discounted price or an opportunity one is getting. The other interesting ideas are, I think everybody should have an online term policy, auto policy. Online is the way to go. Intermediary is not being there. Again, here there's no risk because the intermediary charge is taken away by the companies, and you're getting at a cheaper rate. There is a top-up, super top-up insurance policies which are available if there is a health incident which happens. So instead of paying paying the entire amount. The company say that you bear, let's say the initial amount, which is 2 lakhs or 3 lakhs, and over and above that you would pay. So the premium for this policy comes cheaper, and the first policy can take care of those 2-3 lakhs of expenditure which can be borne by self individual or the corporate policy. Similarly, buying critical illness from separately rather than having an add-on to any other policy, using no-frill broker accounts. Why would we want to pay somebody excessive amount of money for no value addition? Peer-to-peer lending has become very prominent. If you want to borrow money for a short period of time, there are these websites which are available which offer at no documentation or low documentation for a period of time, and also there's an investment opportunity where you can invest your money if you're HNI into some of these peer-to-peer lending sites. Reverse mortgage for some old people who are not able to meet their expenses, they could mortgage their house and post their demise, the house is auctioned and money is given to the people who bequeath their house. So that's an interesting concept I thought one should be aware of. Savings bank, I really don't believe that somebody has to put money in the savings bank, but even if somebody has to, then there are banks which are offering a higher rate of 6-7%. Why not use that opportunity? There are lots of new investment vehicles which are coming, which have come, which are in the nascent stage, which will become big in the next 5 to 10 years time frame. One is the alternative investment funds, but it requires an investment of 1 crore and above. Great strategies which some of the people are running, and so if you want to invest in some strategies, I think one has to explore these opportunities. Then REITs is something which India will see the light, if not this year, next year. So the next 5 years you would have real estate investment trust, which is, for lack of a better word, equivalent to a fixed deposit kind of a thing, but also having capital gains in it. So why should DLF have all the fun? They will downsell it to an investor like yourself, and you can invest money into the REIT and get some return out of it. The last but not the least and the most important is one has to invest in one's health, learning and development, and appreciate the efforts of Imarticus to give an opportunity for people to go and learn things. This huge open education system has become a massive hit. So if I were to take a course in anything like data programming or astrology, there are courses available online by best of the faculty, and the kind of marketers are working on such programs, which is phenomenal. So investing in one's health and learning and development is the most important thing, if not anything else, for one to grow as an individual and for the family as well. So at this, I would stop, and I would want to take questions if there are any.
Hello. Have you received any questions personally, or do I ask you the questions that I have received?
I didn't receive any.
Okay, sure. So the first question would be for someone that has just started out, what would be the best plans for best investment plan for them to get maximum gains? Okay.
So if somebody would have started out, it depends on the horizon. If the horizon is about 3 years and greater, I would say one has to go with either balanced funds or equity funds. I think that's the starting point one has to have.
Okay, so the next question would be, how do you know which sites are best for HNI for the investment?
Sorry, which? Repeat it again.
Which websites are best for HNIs to invest in?
No, I mean, there are a lot of information which is available, which one can read upon and can gain knowledge. For example, Value Research has a lot of information on mutual funds. Some of the brilliant articles are written in Value Research. Mint carries a lot of very good articles. As a newspaper, I think they do a very good job. They have a Mint 50 list both in insurance as well as mutual funds, which one can take advantage of. There are articles on ET Wealth is a good subscription one can do. So every Monday there's this add-on subscription which comes, which is ET Wealth, which talks about various investment vehicles, right from your fixed deposits to post office savings, to mutual funds, to insurance, etc., etc. So these are the ones which one can do. But I would tend to believe that one has to read up on a lot of things, like if you are an HNI, if you want to invest personally, so reading up on Warren Buffett or Peter Lynch, Howard Marks, and all these people who have written, and there are a lot of free articles or monthly letters which come from let's say likes of Bill Gross, Howard Marks, etc., and the AGM, which is done by Warren Buffett. So these are some of the tools which one can use to read up and just try to refine one's investment process so that they are adept in what they're investing in. Yeah, next question, please. Hello?
Excuse me, sir.
Yeah.
Sir, may I know why structured mutual fund is coming in once in a while, even though each and every mutual fund or AMCs they are giving? I don't know why structured mutual fund. It is for structured mutual fund. I know that they will allocate for this for specific certain goals and objectives like that. But no, it's why it's coming in once in a while. You can able to give it in an AMCs on a monthly basis. Other like mutual fund is going to do like.
I'm sorry. What is a structured mutual fund?
No, yeah. May I know why structured mutual fund is coming once in a while in the market? Because it's not available for each and every time.
Okay. So I don't know what you might be mentioning, but if you're talking about let's say things like FMPs, which are fixed maturity plans, which come once in a while. The reason being the opportunity lasts only for that much period of time, and to take care of that opportunity, the FMPs come at a irregular times. Otherwise, if you take normal mutual funds, they are open for subscription throughout. So if you're talking about NFOs, which is the new fund offerings, then these are funds which again come whenever there is an opportunity available in the market, because the essence of the fund, for example, if somebody were to capture the small cap opportunity, which means you identify 20-25 stocks, you would want to invest 200-300 crores, then the AMC goes into the market to get those 200-300 crores and invest in this particular NFO. So that you cannot do in a normal mutual fund, because already there is existing investors. The size may not be permitted. You may not get the required quantity which you might get. So for that reason, the AMCs come up with the new fund offerings, which have a specific mandate and suitable for specific kind of investors, and the defined term is defined, and hence, post that you will get the money back, or it gets merged into some other fund they might have predefined. So it's all basis on the opportunity available and how much corpus one would have to raise. Yeah, next question, please.
Okay, so our next question is, how does a retail investor invest internationally, and are there any regulations that limit or facilitate the investment?
How do retail investors invest?
Internationally.
Internationally, okay. So there are lots of international funds which are available in India. So these are called feeder funds, which means that they collect money in India and they send the money abroad to invest in those funds. So Birla itself has got about 3-4 funds which are available, which can be invested. So let's say if you were to invest, if you want to invest in global commodities, you know that the cycle is, let's say, about to revive, and the companies which do this kind of work, which is dig out commodities and sell in the open market will do well. So you would invest in a global commodities fund in India, which would in turn invest, feed that money into the international fund. So that's one way of doing it. There is no hassle of investing, because if you invest directly into international stocks, then there is RBI approval which is required, because you are transferring some amount of money into the foreign account to buy the required stocks. But whereas if you invest in the domestic funds, the funds themselves take care of the investment. One of the most popular things which has come is investing in US stocks from India. So there are quite a few funds which divert the money to the US stocks, and whenever you would want the money, you just put a redemption request, the money comes back to you. On the other hand, you can buy stocks globally also. All you have to do is contact your trading account, the one who runs the trading account, ask him to get all the approvals for buying internationally. So he'll set up everything for you. Then tomorrow, if you want to buy a stock in, let's say, Apple in US, or if you want to buy BHP Billiton in London, you're all set to go. There is some amount of paperwork which is required in terms of the transmission of the money. The limits on sending out the money, which is defined by RBI, still holds. For example, today the rate is about the limit is about $250,000. You can buy up to that much. The rate was $75,000 a couple of years back, but it has been changed, or the limit has been changed to $250,000. One can invest up to that directly in the international markets. So it's become very easy to do it. At this point in time, one had the inclination to just go out and buy the stocks. So there are two ways available. Simply put, one is domestic mutual funds feeding into international funds. Second is going directly buying international stocks on international exchanges through your trading broker.
So what is your view on value investing? Do you think it's a sustainable strategy to follow?
Yeah, definitely. I think value investing is the essence of investing is all about creating value for the investment which you have made. So the way to make money is buy something which is lower than intrinsic value and see that gain intrinsic value or go over it. So value investing is a sustainable phenomena. Warren Buffett, by following the philosophy, has made tons of money for himself without doing anything else. So and a lot of other people also following his strategy are making it every day on a regular basis. We as fund managers also are looking at that. There are various, so some markets have some issues. For example, India, there are not too many, pure value place kind of a thing. So you would have to redefine yourself as to what value means to you, and then put money there. So we are mostly growth-oriented market. So we have to redefine some of the strategies which is defined in the US for investing. But I think value investing is the recipe for investing in any case, and that will sustain for a long, long time.
Okay, so we have a question on choosing your advisor. How do you choose an advisor, and what certifications do you need? Do you think that the fund manager needs in terms of knowledge?
You mean what certification do the advisor need?
Yeah, like how would you be able to rate a fund manager in terms of their knowledge? Like what certification would they need to have?
Okay, so fund manager, the selection process is taken care of by the mutual fund, which is recruiting the fund manager. So typically these are people who have had education background from top tier schools, having a finance degree, or somebody who is a chartered accountant, or somebody who is exceptional engineer who has worked in the finance field across the world. So the mutual fund select the fund managers themselves, because at the end of the day, as I said, the last point, the trustworthiness, we would want to have our investors have trust with us. And the only way to have the trust is by recruiting right kind of people onto the team. So the mutual fund, the CEO, the top management do that due diligence to recruit the fund managers. But coming to advisors, which individuals have to select, So I would say that advisors have, I mean, depending on the locality which you are in or region which you are in, you would want to, rather at least I would personally want educated individual who is very curious about what is happening around the world, and one who can correlate with what is happening around the world with the investment opportunities which are happening, which are available to an investor, and then track it on a regular basis, so that at the end of the day, the mistakes, and there are lots of mistakes which one does, and even some of the most guys who are successful, they keep saying that the fun of markets is that every day you are there to learn new things. Every day is different from the previous day. Every instance is different from the previous instance. So we're all there in the markets to learn new things, and so are the case with the advisors. So if they have the curiosity to learn and to implement the things, the ideas which are there, understanding your needs, as just explained, if somebody has a need of let's say 20-year horizon of investing, one would suggest one methodology of investing. If it was only for 6 months, then he would suggest another way of investing, and keep abreast of things which are happening around the world. So primarily, very curious person who can correlate with what is happening around the world and translate into investment opportunities for you. Certifications, yeah, SEBI mandates certifications. There are NISM exams which the advisors have to pass. They would have to register with, if they are calling themselves advisors, they would have to register with SEBI as an advisor. So these are the various certifications and regulatory procedures one has to follow, and the advisors have to document what the recommendation investor is giving. So there are strict things which are followed by SEBI. So one has to be cognizant of the fact that your advisor has the same.
Yeah, while we're taking in other questions, what would you say, to what extent would the certifications from NSE help retail investors?
What extent do they help retail investors? They themselves taking or advisors taking the exam?
I think the advisors.
It is for the advisors taking the exam.
For themselves.
See, yes, exam. So as I said, market every day is a new day. So even if you have done studies on a particular topic, so the good thing about the certifications and the examination is that it covers a lot of base in terms of what is relevant to one's profession. But then once you're into the profession, the things which are happening around are completely different from what is theoretical in nature. So as I just mentioned about the multi-order derivative effect, wherein the genesis of the crisis has happened in the United States in 2008, and if you plot a graph between US from 2008 to 2016 versus the rest of the countries, US stands out as the best market in the world in terms of returns. Similarly, if you take oil, if world was going crashing in 2008 when the growth was coming down, oil was still at $120 per barrel. But whereas in less than 2 years, in the last couple of years, oil has fallen from $120 to about $27, and now it's back to about $47, $48. So the certifications and exams give only a wide base of information, but what is relevant, and going back to the correlation of the curiosity and correlation to the investable vehicles, is that one has to understand why it is happening, what is happening, and then trying to map it to whether I should be, and my investor has to be there in this investment or not. So examination, pure play would not help, but just that's a hygiene factor. So it's like going for medical checkup every year, but then exercising regularly, eating the right food is essential for one's health. So it's a similar thing.
Okay, so we have another question. Do you think products like CDOs and IRS will ever come to India? Do you think as a fund manager think these products can give you more of an edge in making better returns for your investor?
Yeah.
In making better returns.
Yeah. IRS is already there in India. In fact, we have a fund called Villas and Life Floating Rate Long-Term Fund, which takes exposure to the IRS to make some incremental returns. So IRS has already come to India. CDOs is something which are not actively traded. It's a good product. So see, end of the day, every product is a good product. It's just that you know, you would have to be cognizant of, or rather, regulators have to be cognizant of the fact that how much can be lent, how much can be the risk in the expansion of that particular industry. So CDOs will see the light of the day in India as well, but IRS is already there. I see a question here, Vignesh. It says, why there are tough regulations for hedge funds in India while the ruling government is pro-business? So if I understand correctly, so you are talking about the AIF regulations, and if a hedge fund want to run category 3 fund, which is the AIF, there are tough regulations in that. See, pro-business doesn't mean that it's pro-market, so both have to be de-linked. So regulator has a role to play in keeping the integrity of the market, and hence there are these kind of regulations are required. I would not even say that it's hugely tough. I don't know what exactly you're talking about by having tough regulations. Regulation in terms of minimum ticket size of 1 crore plus, and regular disclosure of your portfolios and the NAVs, etc. It's just hygiene factor which every individual, every firm has to subscribe to. In terms of taxation, that's been a confusion which is happening, but you know what? There are a lot of people who are still taking advantage of the opportunities with the taxation and the kind of products which you're talking about, which are AIF Cat 3. So obviously no taxation is good, but even with the amount of taxation which they have, they are still able to garner assets because there is a value which the investors are seeing. So I believe that regulations are required. Some people treat it as tough regulations, but as long as integrity of the markets is safeguarded, I think it's fine. I hope I'm able to answer it, Jay Vignesh.
Okay, do we have any more questions? Okay, thank you, Mr. Shravan, for this lovely session. I'm sure that all of us had a great insight into the contemporary investment strategies that we could take forward. The attendees of the webinar will receive the recording for this webinar shortly, within the next week. This video will be available on YouTube. Thank you for coming.
Thank you, Marticus, for giving me the opportunity and sharing my thoughts and beliefs to all the participants. I just want to stress upon that these are my beliefs and my understanding. Everybody have their own philosophies of life. So if they're discordant with any of you, when we meet personally, we could have a debate and discussion on that. But I just want to say that I think India is in great footing for the next 15-20 years. One has to take risky bets within the limits, the risk profile limits which it allows. But India is a great market. Keep investing. Happy investing. Thank you.